Some people have difficulty doing unearned revenue adjusting entries, so we're going to be covering this now. And adjusting entries regarding unearned revenues might be a little bit harder to conceptualize just because unearned revenue is considered a liability, and the reason it is a liability we'll get into, but I think I've mentioned that in the past actually, and we'll also get into why unearned revenue doesn't show up on the income statement as revenue, and that has to do with, since we haven't earned it, it doesn't show up on the income statement. So we're going to be talking about an example that actually has to do with, which is pretty common to everyday life, which is magazine subscriptions. I actually closed the wrong layer there. But we're talking about magazine subscriptions, and let's say that we have received $240 for one subscription that is going to last for 2 years or 24 months if you expand that to months in total. And let's just bring up this layer. We're obviously receiving money, obviously in a burlap sack, because that's how everyone pays for goods and services in this day and age. And we're receiving $240, and on the 1st of August, because it is the 1st of August, I'm stating that we have received this at the 1st of August, and the entry we might have to make will look something like this. We're going to have to debit cash to show that we've increased our cash by $240, and we're going to credit unearned revenue for $240, and it is considered, we're increasing our liability unearned revenue because, and it's a liability because we owe a service, and liabilities are essentially we owe something. Like accounts payable is that we owe money, unearned revenue is that we owe a service to earn that revenue. And the reason why we can't actually consider this as revenue yet has to do with something which is known as the revenue recognition principle. So the revenue recognition principle, it's one of those GAAP principles that basically states that you have to earn earn the revenue to actually report it as revenue. And the way we're going to earn revenue is by actually physically sending a subscription. So every time we send one magazine to our customer, we can report a little bit of earned revenue. So let's see how that looks, because that's going to be our adjusting entry. So this is not our adjusting entry. This is just to recognize that we have essentially received cash and reporting a liability. What our adjusting entry is going to look like, let me actually write up a timeline really quickly so you kind of get the idea of this. We're going to be shipping magazines over the next 24 months. That obviously isn't 24 lines, but let's say it is the end of the first month. So we're right here. It's the end of August. We're now at August 31st, and we've now shipped one magazine. So like I said about the revenue recognition, we can report it as revenue once we've shipped the magazine and our earning process is essentially almost complete. So now we can show that we have earned a bit of the revenue, because we can't show that we've earned all of this $240 worth of revenue. We can only show that we've earned a bit, or exactly 1 month of revenue. So how are we going to do that? Well, we at the beginning of August 1st, we debited cash and we credited unearned revenue. So cash is not going to change. It never changes for adjusted entries if we look at these rules. What we are going to have is a revenue entry. Look at the rules and make sure that, is this going to be a revenue or an expense entry? This is going to be a revenue adjustment entry. So what we need to show is we need to show that we're reducing our liability because since we shipped one of those magazines out, we're not liable for 24 magazines now, we're liable for 23 magazines. So our liability gets decreased by a bit. And how much is it going to get decreased by? Well, one magazine, how much is one magazine going to be of revenue? Well, the entire subscription is $240. So $240 divided by 24 months is going to be $10 of revenue we can recognize every month. So we can reduce our liability by $10, and we can show that we've earned revenue of $10. That way we have a revenue account for our adjusting entry, and we've actually earned revenue, which can show up now on our income statement as reported revenue. And just to double check this, like I said, this is a revenue adjusting entry. Adjusting entries never involve cash, and this adjusting entry the purpose of it was to show that 1 month passed and that we have to perform an adjusting entry to show that revenue was earned, which adjusting entries all have in common. They all have to do with the passage of time and either creating a revenue or an expense adjusting entry. So hopefully you kind of get the gist of this unearned revenue adjusting entry. If you have any questions, make sure to leave it in the comment section below. Try and help us by liking out any videos, and I'll see you guys in the next one. I'm sure you guys have questions regarding accounting topics or our videos, so make sure to tweet us at #iNinjaNotes, like us on Facebook to receive updates or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.